Hi there, Sharon Horne-Ellstrom here. Welcome to day 134 of our Be a Better You annual challenge. We're doing one thing every day to be a better version of ourselves, a better human being. Now today we're talking about, and all this month, we're focusing on the financial area and aspect of our life. Remember, financial is one of the 9 life framework areas that I break my personal goals and objectives, everything I do, my decisions, my life. I use this framework to kind of take some of the chaos and craziness that can be our lives and happens in all of our lives and put a little frame around it so that I can manage and create what I want in the different areas and aspects of my life, which altogether makes my life go in the direction I want it to go and creates the life that I want to live. My life is going to be different than yours and everybody else's on the planet because we are all unique, amazing human beings, and what we want is different. A lot of the things we want are similar, but how exactly I want it is different than everybody else, just like you. So today we're talking about investments. What the heck are they? What are some of the type of investments we would want to consider? How and why we consider different types of investments. And then 5 key strategies when it comes to your life and your finances, and 5 strategies to apply to this area and aspect of your financial life. Well, what the heck are investments? Investments are things like stocks, mutual funds, individual stocks, exchange traded funds, EFTs, or ETFs. I always mess those up. ETFs, index funds, anything that it offers high possible returns or potential returns, but it also comes with market volatility. It's dependent totally on the market. And I have a horror story about the stock market, because when I was younger and I had a high risk tolerance, which we'll talk about in a little bit, and I didn't care because I knew it was going to be invested for a long time. I put most, if not all of my, it was before real estate, so I put all of my investments into the stock market. Why? Because I was young. I figured I had time for my investments to grow and I could take on the risk of sometimes losing it. Well, in 2008, I got to test my theory about risk tolerance, and I realized I didn't like it. I didn't like everything being in one basket, and lost millions of dollars in the stock market during that time, which was basically my entire retirement income. And was married to someone who thought it was better to sell than lose everything, which ended up being the exact wrong thing to do, but we never know that till after the fact. So there's stocks, there's real estate, which is got involved in real estate at about that time, a little before, I suppose. And you could have rental properties, you can have real estate investment trusts. You can invest in those, which is a way to invest in the real estate market without having to physically do a whole lot of things. You can do house flipping, which is a whole lot of work, but a whole lot of fun too, if you like that kind of thing. There's other ways to buy, you buy low, sell high when it comes to real estate. It provides passive income with respect to rental income, sort of passive, and tax advantages. There's lots of tax advantages to owning real estate. It's best for investors looking for tangible assets that offer a consistent income stream, and that's part of why we switched back at that time from the stock market to real estate and got involved in different aspects of real estate. There's also bonds and fixed income producing assets. Bonds like government bonds, municipal bonds, corporate bonds offer a consistent amount of interest. Therefore, people that are conservative and don't want to take a lot of risk. And then there's retirement accounts as well as alternative investments. Retirement accounts, 401ks, Roth IRAs, IRAs of our own. Why these are one of my favorite investments is because in corporate America and a lot of jobs, and still in many, at least for managers and executives, there is a company match up to a certain percentage of money that you put in your retirement account. I think the most I ever had was there was 100% match up to a certain ceiling, a certain amount of money that you put in. I think it was probably like $40,000 or something. And then after that, it was like a 50%, and then it had a scale that went down. But it was still free money in my mind. It was like, if they're going to match it, I'm going to put the absolute maximum into that. And I don't remember who taught me that, but it was super duper smart, and I always did that when I was in corporate. And then there's alternate investments, right? We can invest in cryptocurrency. We can invest in commodities like oil and gold and silver. excuse me, we can invest in private equity funds and things, or private equity. We can do collectibles. I know a gentleman that literally has hundreds of cars. He collects automobiles, but you could collect wine, you could collect art, any kind of art that appreciates in value, right? Anything that appreciates in value, you can collect. I know somebody that made a ton of money collecting Beanie Babies as a hobby, but turned it into a business. So it's up to you to decide what investments feel right for you. I'm going to share a couple of people's examples of their investment strategies, and then I'll give you 5 strategies to keep in mind when it comes to investing. And my action item for you today is just to ask yourself and review, number 1, do you have any investments? Do you at least have a savings account and an emergency fund? If not, we're going to talk about emergency funds tomorrow and why it's critical to have one. But today, just ask yourself and do a quick little assessment and audit of, do I have investments? And then see if they meet the 5 strategies I'm going to share with you. First, let's look at Daniel's story. Daniel is a consistent index investor. He started when he first got out of college, and he decided that at 20, well, I guess he was out of college a little bit, but at 25, he began putting 15% of his income into a Roth IRA. And his employee matched that with 401k. And so instead of just putting in 15%, he was like me, actually putting in 30% of his salary into his retirement. He was focusing solely on low-cost index funds like the S&P 500, so he wasn't taking on a whole lot of risk. He was just letting it grow over time because he knew it was going to be there a while. And the outcome was that by avoiding speculation and staying invested through market downturns and upturns, his portfolio grew steadily. At 40, he had over $350,000 in his retirement savings and was on track to retire early. It's a goal for many people. Impact on his life, it gave him financial stability and financial security, so it reduced his stress about money and empowered him to explore career changes without fear of financial collapse. He knew he had options all the time, and I've talked about that. Part of why I had businesses while I was working in corporate America is I could be who I really am and lead how I chose to lead, even if it was a little bit on the edge of what other managers were doing, because I knew if I were to lose that job, I still had something, and I still had the bills covered, and I was able to do what I knew was right all the time instead of doing what was easy. And a lot of people fall into I have to do this because my boss told me to, or I'm going to do what's easy because they're afraid of losing their job. So I'm just going to share Daniel's story today because I find when I share stories, we go really, really long. So what are these 5 strategies that we want to think about when we are investing or deciding what type of investments are right for us? Number 1, start early and be consistent. Start today. If you're not doing anything and haven't done anything, start today. Put $5 a week aside. Do something and start investing it into something. Nowadays, there's so many tools and so many options that you don't have to go out and find brokers and investment bankers or investors and people to do it for you. You can actually do it yourself, which is actually strategy 5. And that is to educate yourself. Financial literacy is one of the greatest assets you can achieve, the greatest areas you can, because investing is all about creating wealth for you, right? Everybody else is out on in the planet creating wealth for themselves, and guess what? Nobody is going to do it for you, so you have to educate yourself and know what is right for you. Second strategy, and I will echo this 100% from my personal experience when I did not do this: diversify your portfolio. Do not be like me and put all your eggs in one basket, especially a basket you have no control over. Part of why I am so adamant about having your feet in both worlds, both the online and offline world, but also a job as well as a side business or side hustle, but a business of your own, is because, well, there's all kinds of tax advantages to it. There's so much security and stress reducing, along with, yeah, businesses are stressful, but they don't have to be. It's if we choose to make them hard and stressful. But there's so much sense of peace and well-being that goes along with that it's worth it. Know your risk tolerance. Again, I used to be very risk tolerant when I was young, and the older I got, the less risk tolerant I was. And then after a big loss in one area where I had no control, I knew that my risk tolerance meant I had to have more control over what was going on with different things than just letting it ride. And so that was part of why we got involved in real estate and real estate investing, as well as businesses and different type of businesses on the side. And then finally, my fourth but of the 5 strategies is automate what you can. So I think we talked about this already. Automatically put money aside, pay yourself first off the top before you ever get that money in your checking account or debit account, whatever you use to pay bills and things. Take it and pay yourself first off the top. And if you automate that and then reinvest the dividends and things, depending on the type of investment, if you're in stocks and bonds, there's dividends and interest, reinvest that and take advantage of the effect of compounding. That's it. That's all I've got today. I am obviously not an investment expert. If you're looking for an expert, there are a gazillion of them out there, and I could recommend a few for you that are awesome and have high integrity. My nephew is a very wise investor, very young but very wise. So just audit yourself today. Say, where am I? How do I fit against these strategies? What's my risk tolerance, number one? I always ask myself, okay, is this too risky for what I can tolerate? Can I tolerate the ups and downs, and for how long? The younger you are, the easier it is to take more risky investment options. Start early. Have you started? And be consistent. Have you started? Have you automated it? Are you consistent? Decide and put X dollars away every single month off the top, or weekly, or whatever works for you. Have you diversified your portfolio? If not, start today. Automate and reinvest. If you haven't done that, start today. And again, maybe it's just starting with $5 a week or a month. Whatever you can do it. And then 5, educate yourself. Learn what investments are right for you or not right for you. I guess I could talk about why I've chosen and not chosen to participate in different things along the way. Crypto, for example, too risky for me. I don't trust it yet, and I don't believe in it. I'm not going to invest in it right now. So if you want to sell me crypto, don't bother. All right, that's it. Have an awesome day. If I can help you anyway, ask. Otherwise, I'll see you tomorrow.